Welcome everyone to the Program for Financial Studies No Free Lunch seminar. We have people joining right now. I think we're starting relatively on time, and I'm very appreciative of all of you in our audience who are taking time out of their busy work days to spend an hour with us and actually take some time to take a step back from the world and think about bigger picture questions in finance and economics. It is my pleasure as the director of the Program for Financial Studies. My name is Melina Dennebeim, and I direct the program with a faculty member in our finance department named Harry Mamaysky. And on behalf of the Program for Financial Studies, we're delighted to have everyone here today. I have two fantastic new faculty members, relatively new faculty members at the business school, who both are focusing on very different areas of research. Yiming Ma is an assistant professor in our finance department, and her research focuses primarily on intermediation, financial stability, and monetary policy. So she really looks at capital markets and policy in the banking system. The research she will be presenting today will focus on let me pull up her actual research presentation. Yiming, what is the title of your research presentation?
I will be talking about disruptions in debt markets during the COVID-19 crisis. There's a focus on the role of mutual funds and their liquidity transformation.
Okay, great. Thank you, Yiming. And Laura Boudreau, who is in our economics department, also focuses on actually quite a range of economic topics. And her work focuses on working conditions, labor rights, and firm productivity. She spends a lot of her time researching on developing countries, Myanmar, Bangladesh. And today she is going to be bringing the discussion closer to home with a focus on looking at how to create incentives for employees to fairly opt in to reporting COVID-19 status. Which is an application of a more specific application of a general incentive structure. So I just also wanted to give a brief, a brief update on the Program for Financial Studies. We kicked off our semester with some programming. This is our first no free lunch. And next Tuesday at 7 o'clock, we're hosting a crypto investing seminar with two private equity and venture capitalist investors to talk about the state of the crypto investing community and also looking at it as an asset class and current and future applications. We will be having more seminars. We have a Big Data for Better Business seminar series, which integrates finance economics in the overlap of data science and analytics. And then we have another no free lunch on November 16th with Professors Carrie Chan and Will Ma, who will be focusing on very different topics outside of finance and economics. Carrie Chan on healthcare operations and Will Ma on video game optimization. So we try and represent some of the most interesting and different research going on at the business school. And I'm delighted that everyone is here, and please feel free to ask questions through the Q&A button at the bottom of your screen, or the chat, but preferably the Q&A, as that will be more streamlined. And each presenter will be speaking for approximately 20 minutes. At the end of their presentation, they will field the questions, and so we're not going to intersperse them through the presentations. We'll wait till the end. But thank you, everyone. Please enjoy your lunch, whatever you're doing. We can't see you. Relax, sit back, and really take and absorb this information and enjoy the next hour. Thank you so much, and I actually am going to pass it to Laura now, who will be our first presenter.
Thank you, Melina. I'm going to share my screen. Thank you for the opportunity to present in the No Free Lunch seminar. We're very excited to get feedback on this research agenda. This is joint work with Sylvain Chassing, who's a professor of economics at Princeton University. And the problem that we're interested to address in this work is that major threats to employee well-being often go unreported. And undetected issues can result in catastrophe, not only for those employees, but for the organization, for its kind of clients or customers, and for other stakeholders. So this headline is from the Germanwings plane crash in 2015, which killed 150 people, and in which the co-pilot, who was kind of at the controls, was found to have hid his mental illness from his employer in the run-up to this horrible event, which may have contributed to the crash. We recently hear, probably most of us are probably familiar with the Me Too movement, which revealed kind of cultures of sometimes pervasive sexual harassment in organizations, where women and other survivors of this behavior did not feel comfortable reporting this type of harassment. There was kind of recently a major study that came out on burnout among healthcare providers, which could have major adverse consequences, not only for those providers and their families, but obviously for the care, the quality of the care that's being provided to their patients. And so, when employees are facing these types of problems, there's the clear question of why don't employees choose to report? And there is academic research on this, as well as some kind of evidence that we've collected from the setting that we studied, which I'll talk about a little bit later. But it's kind of probably unsurprising concerns. So concerns about their perceived duty to the organization, concerns that they may face stigma, for example, related to mental health issues, career concerns, they don't want to jeopardize their future, fear of retaliation, so I may not want to report harassment if I'm concerned that my harasser may retaliate against me, or if I'm someone who's aware of a coworker who is either in need of help or who has kind of perpetrated misconduct, I may not want to report because of my loyalty to those coworkers or my concerns about their career. And we think that these types of issues are particularly timely during the COVID-19 pandemic in relation to COVID-19 risk and exposure. So many organizations' workspaces are either fully or partially open. So we're thinking about both frontline producers and providers of services, as well as many office spaces. And in these contexts, employers have, there's a clear need to prevent COVID-19 outbreaks that happen through the workplace. And in order to do so, early detection is key. But the concern is that employees may not want to report if they have potentially been exposed to COVID-19 or have symptoms that may be symptomatic of COVID-19 because they may fear stigmatization by their colleagues, which is a common concern not only in the workplace, but more broadly with COVID-19 and historically during times of pandemics, that individuals who come down with the disease are socially stigmatized, sometimes even after they become well. And we really focus on stigmatization as the concern here, but one may also be concerns that an employee, or I have heard kind of cases where employees may not want to report exposure, for example, because a manager is kind of focused on very short-term production deadlines or objectives, and may not be happy or willing to allow that employee to take medical leave. And so we think that lessons from social science research on indirect survey methods can be brought to bear on this problem in a way that can be very helpful. And in particular, we're thinking about randomized response survey methods that have been kind of around or used by social sciences for decades. And the key behind these methods is that they provide respondents with plausible deniability. And in order to do so, they add random noise to respondents' answers. I'll show you kind of a very clear example of how this works in a minute. And so kind of from the surveyor's perspective, the surveyor can still estimate a group level statistic, which is often what we're most interested in. For example, what proportion of employees have been exposed to COVID-19, but they cannot infer from an individual respondent's recorded answer whether they submitted a sensitive answer because that answer is true or because of the survey protocol itself. And so the key here is that this kind of inability to infer based on a sensitive answer, whether it's the true response or the method, is what provides that survey respondent with plausible deniability about how they responded to the question. And these methods are widely used, as I mentioned, in the social sciences to measure, for example, illicit behaviors such as doping among athletes or socially undesirable beliefs. And more recently, in particular, my colleague Sylvain Chasset has worked on the theory behind enhancing these methods, in particular using a hard garbling technique, which are better suited to organizational settings where retaliation and stigma may be likely. And the key difference between hard garbling, and I'm happy to talk about this, the methods kind of a little bit more in the Q&A session if we have time, but the key difference between traditional randomized response methods and hard garbling methods is that traditionally in randomized response, the random noise being added to the data has been added by survey respondents themselves. So for example, they may be given a die and told to roll the die and only respond truthfully if the die lands on certain faces. In contrast with hard garbling, the random noise is exogenously added to the survey responses. And in this way, it's more strategy proof in the sense that if I'm a respondent who's very concerned about submitting a sensitive answer, I may choose not to roll the die and just to submit the non-sensitive answer. Whereas with hard garbling, that concern is less present because the garbling is being done by the survey system itself. And so the cover is there regardless of whether or not I want to comply with that protocol. So let me give you I've already started to describe the method a bit, but let me explain the key idea through a survey question. Now, suppose I'm an employer who wants to ask my employees, in the last week, have you interacted with someone who's diagnosed with COVID-19? There's two possible responses to this question, yes or no. Then there's going to be two possible records of my response to the question. And the key is that if I respond yes, my answer is always recorded as a yes. But if I respond no, 90% of the time, for this proportion can vary, but let's say 90% of the time, my answer will be recorded as no, but 10% of the time, it's going to be randomly flipped to a yes. And so what this means is that as the employer, when I look at the record of survey responses, this record of a yes to COVID-19 exposure may be because a survey respondent said yes, they were exposed, or because their answer was randomly flipped to be a yes. And so that provides the cover that an employee may need in order to be willing to truthfully report their exposure. And just to be very clear, there's a simple formula that I can use to still back out the overall true prevalence of COVID-19 exposure using this record of responses and the probability with which answers are being flipped. Now, this is a useful methodology to conduct a survey, but we think that the times or the cases in which this methodology is most useful is when there's actually an action that an employer, for example, wants to take based on this record of responses. So if I'm an employer and I learn about COVID-19 exposure, I want to make sure that the employees who have been exposed do not enter the workplace and potentially infect my other employees, if it's a customer-facing business, my customers, and so on. And so this is where we propose what we call random rotation policies that are based on this indirect survey method of randomized response or hard garbling that I mentioned, or that I described. And so I'm going to just describe the outline that we propose for how a random rotation policy could work. So in the first phase, the employer would conduct a workforce survey in the flavor that I just described. The employees are asked about their exposure and their symptoms, and employees who respond yes are always recorded as a yes, but there will be, there's a proportion of employees who respond no, whose answers are recorded as no, but then there's going to be some proportion of employees who are randomly selected to respond yes, regardless of whether they would have responded no. Even when they respond no. And so then, based on employees' responses, the employer could assign everyone who appears in the data to work from home for a week. And this ensures that those employees who have been exposed are actually assigned to work from home, but they have cover about the fact that they may have been exposed, because that could have happened, that could have been the result of them being randomly selected to say yes. And so consequently, the assignment to self-quarantine does not provide a clear signal to other employees that these workers have been exposed to COVID. Now, at the end of the week, for example, those employees who've been rotated out, and when we drafted this figure, it was still kind of large-scale testing. So at this point, we said tested for symptoms. This could be directly tested for COVID. And then, clearly there's a need for workers or employees who have COVID to be referred for care. And then in principle, the employer could repeat this survey and rotation policy every week, every 2 weeks, depending on the appropriate time of which shifts are determined, or so on. So this is kind of the crux of the idea for random rotation policies. Obviously, there's a lot of details that would go into how would an employer actually go about implementing these types of policies and tailoring it to their organization's unique needs. And so we try to elaborate on some of these details in our recent article in the Harvard Business Review, which I encourage you to check out if you would like to think more about implementation. And I'm also obviously happy to take questions. And further, we would really love for organizations to start testing out some of these policies. And so we provide implementation resources at this website, safelyreport.org. Okay, now I've kind of talked how this is a general method in the social sciences for eliciting sensitive information. And I want to be clear that, the principles underlying indirect survey methods and the random rotation policy that we describe are broadly applicable. So to give another example related to COVID-19, this summer I read a lot about employees feeling uncomfortable with having to return to the workplace. And there was a lot of uncertainty about how socially acceptable it would be to not return, or whether employers would retaliate if a worker didn't want to return. And so one way, that an employer could kind of help facilitate this process would be incorporating this type of randomized response into their approach to gauging employee comfort with in-person interaction. Similarly, beyond COVID, there's a variety of potential applications. So just to give some ideas, you could see this being used to help target support to prevent burnout. So for example, asking, would you benefit from work relief? And then always providing work relief to those who need it, but also randomly providing work relief to a subset of employees who do not report needing it, in order to provide cover for those who actually do. You could see this in encouraging truth-telling in, for example, 360-degree evaluations, where workers may not feel comfortable indicating that their manager may have underperformed. Kind of in the same vein, you can think about applying this in the context of small committees in order to discourage groupthink or to encourage kind of dissenting opinions, to encourage members of the committee to share dissenting opinions. And not finally, but finally for my list, you could think about using it to encourage reporting of corrupt behavior. So I was thinking about the case of the rogue trader in the UK, but I don't know if a member of that team was aware of the misbehavior. But you could think about having a mechanism like this in place to provide employees who would like to make that report with cover about the fact that they were the ones who may have shared that information with the employer. Now, obviously, I've kind of talked kind of broadly about these indirect survey methods and our ideas for how they can be usefully applied to the COVID-19 pandemic. And I would like to just mention before closing and taking questions that our interest in talking and thinking about these methods in relation to COVID came out of our ongoing research. And so we have kind of an agenda, Sylvain and I, joint with a third collaborator, Ada Gonzalez-Torres, in which we are studying reporting and resolution of labor issues in Bangladesh's apparel sector. And here I just want to highlight some of the major barriers to reporting in this setting. Based on initial surveys and focus group discussions with garment workers, we identify risk of retaliation, social norms and stigma, first mover disadvantage, so in particular kind of in he said, she said type of situations, and then low procedural quality, in particular of kind of these garment factories' internal grievance resolution mechanisms. And so just to provide an example of how we think this plays out, these are workers' responses to a couple of questions about experience of physical and sexual harassment in the workplace. These were not data that we collected ourselves. They were shared with me by some researchers who very, very kindly allowed us to access their data. And so what you see here is that when workers are asked whether they witnessed physical harassment, we see 20% of workers reporting yes, sometimes very frequently, although I've coded it here as a binary variable. But when you ask if they've experienced it themselves, this almost goes to zero. We see about 1% of workers reporting yes. And similarly with sexual harassment, it goes from about 11% of workers witnessing it to essentially zero. So this is one person out of 1,500 people, where 2/3 of these respondents were women who reported actually experiencing it. And in this context, we have reasons to believe, although we hope to document this in our research, that sexual harassment is actually much more prevalent, and that the differences that you see here between witnessing and experiencing is actually all due to concerns about reporting. And to concerns related, we think, to these issues that I've just mentioned in terms of barriers here. And so this is part of kind of the motivation for our ongoing projects, the first of which is a survey experiment on measurement of sensitive information, in which we have 3 goals. The first is to learn how plausible deniability and trust affect reporting. The second is to learn how we can collect information through these surveys that can be used to predict misbehavior and victimization. And then finally, to calculate policy relevant statistics about harassment. So in particular, we know that our estimates are underestimates. We know that more than one worker in the sample likely experienced sexual harassment, but we have very little idea of what that true number is. It could be that 11%, it could be much higher, and so we hope to provide policy relevant statistics not only about the share of people experiencing this type of harassment, but on many other aspects as well, such as whose share of managers who are perpetrating it, for example. And in our second project, we are working on an experiment on the design of enhanced whistleblowing systems. And here, just to provide a bit of information, we're collaborating with an independent grievance resolution system set up by multinational buyers that source from Bangladesh's apparel sector. It's a helpline called the Amidir Kota helpline. And in collaboration with the helpline, we're going to implement an experiment in which we incorporate a reporting escrow for harassment into its grievance resolution process. And this is a mechanism that I have not described in this presentation, but the idea behind a reporting escrow is that it allows a victim of harassment to deposit what we call a soft report in an escrow, or kind of an information account, that is held until a kind of certain number of reports, for example, 2 or 3 of the same report come in, and then only then does it trigger an investigation. And these types of escrows are increasingly being proposed to encourage reporting of issues like sexual or physical harassment, where a worker may lack hard evidence of the behavior, or may not be willing to provide a report, unless others also come forward. And then finally, the second aspect of this experiment is to implement what we call garbled targeting. So this is this kind of information garbling that I've been talking about in this presentation, but where we're going to hopefully garble the targeting of the helpline's outreach to workers and managers in the way that I mentioned, to be able to target support to workers who need it, while preventing or while making sure that that does not expose them to stigmatization or to retaliation. And so, yeah, I just wanted to kind of connect the dots between what I was presenting, what I've shared about how these concepts and ideas can apply to COVID, with how we're applying them in our own work on these topics, or on related topics. Okay, and I'll end there. I actually have no idea how long I spoke for, so I hope that was somewhere near 20 minutes. But if you have any questions, I'm excited to hear them. If you're interested to learn more, I've already mentioned a few references, and also please feel free to reach out directly. We'd love to hear from you. So thank you.
Thank you so much, Laura. That was really interesting. And I do see a few questions in the Q&A box. So if you want to go ahead and take a look through,
sure,
and then feel free to respond.
Great. Melina, do you want me to keep my screen sharing on or stop sharing?
You can keep it on in case you have to reference a different slide.
Okay, I'm having some trouble let me try getting out of the full screen and seeing if it makes it easy. I can't see the Q&A right now, so I'm just trying to get out of the full screen.
Well, I can read you one of the questions. So
sure.
The first one is about the administration of the survey. Is it administered through electronic means? And also, if there are populations that don't have access to electronic responses, such as farm workers or food processing or garment workers, how would that be addressed?
Yeah, so that's an excellent question. So we actually, on safetyreport.org, provide 3 different possible implementations. So you can certainly implement the survey in instances, in cases where the respondent does not have access to the internet, in cases where they do have access to the internet, and you may choose different indirect survey techniques depending on which type of population is participating in the survey. So in the hard garbling implementation that we provide, that's this exogenous flipping of people's answers. It relies on underlying encryption of answer codes that's being done by computer software. So in that case, we provide 2 implementations, one of which is completely computer-based, and then one of which you use the computer to generate these codes, and then you can actually use like a paper-based survey with these kind of computer-generated codes with survey respondents. And then finally, we provide a fully paper-based solution that uses the kind of traditional randomized response technique that I mentioned, in which the trade-off is that there is this kind of possibility for people to not comply with the survey method. But for example, where you kind of use a deck of cards and then you hand out cards to people that tells them whether to just say yes, that's kind of randomly assigned to yes, or to actually answer the question yes or no. And you'll have some share of cards in your deck that are just a yes response, and that's the cover, and you kind of do this shuffling and hand them out. That's kind of the general gist. Or maybe that's a little bit of a long-winded answer to say that yes, you can certainly implement them with multiple types of populations.
Laura, and then a follow-on question that relates to what you were just describing about the mechanisms. So how would you describe the random rotation process so that the survey takers understand it and therefore trust that they'll have plausible deniability?
Right.
Most
so
say they're anonymous, but there's also a level of reassurance that people need, and a general level of mistrust if they don't trust the institution and the situation in which they're
absolutely. So I would say two things. First is that we are very interested in the extent to which trust influences respond. So there's kind of two issues. There's understanding of the survey protocol, and then there's trust in the institution that's implemented. I may understand how the survey works perfectly, but I still may not comply because I don't trust the survey implementer. So we can talk about both of those issues. Just to mention, one thing that we propose that we think would be valuable in the context of an employer that would actually want to implement this is that they would ideally work with a neutral third party who could actually administer the survey and collect the data. And by doing that type of outsourcing, that may contribute to increasing trust. We do have, and I'm happy to talk more about, ways that you can actually provide instructions or clarify to survey respondents, how the method provides them with plausible deniability. I think that it requires some thought for, how to actually go about phrasing them. And we've done we've actually have some kind of materials on that we haven't posted online, but that we would be happy to share. So I think the key thing, it is crucial that survey respondents understand how the survey is providing them with plausible deniability. We think that's achievable, and we are kind of testing out. We've seen that it's definitely achievable with certain populations, but depending on the kind of level of education, for example, garment workers tend to have less education. We have to be do a lot of we have to be very confident that we can convey how the survey works to those workers. So just, I'm not sure who asked that, but just to say, it's something we've definitely thought about and have ideas and resources for it that we would be happy to talk more about and share.
Okay, and I'm going to just field one final question. We had a couple more, but in the interest of time, going back to the phases that you outlined in the process, in phase 4, the question is, aren't employees outed anyways when they're sent home if they are symptomatic?
So you could think about two things. So in one possible implementation, you could kind of out an employee who actually has COVID, and that would still ensure that people who do not actually contract COVID but may have been exposed would have been given cover and would not have been stigmatized. In principle, you do not have to share they can be bunched in with those yeses, and it doesn't have to be readily apparent to the rest of the community that they're being rotated out of the workforce because of the fact that they that they actually had COVID. there's also a need to do, there's privacy trade-offs that may need to happen in relation to contract tracing. So, we understand that it's a kind of a nuanced and a kind of complex decision-making process that may need to occur. And so, I think that decision, that may vary depending on the specific circumstances involved. Yeah.
Great. Well, thank you so much, Laura. It's a really interesting and very timely presentation.
Thank you.
And I know that there were some other comments and questions, and I do encourage people, Laura, if you're okay, to reach out directly to you or to contact
please.
your website, because I think this is very interesting and a lot of people are probably thinking about active applications.
Great. We would genuinely love to hear from you. And so please, feel free to reach out. And now I can see the questions and I'm going to copy them all down. So thank you. Yeah, thanks very much. I'll stop sharing my screen now.
Thank you, Laura. Okay, now we're going to very much change gears into another interesting topic related to the debt markets. And I'll pass it to Yiming, who will present again for the next 20 minutes. We do expect, we had budgeted from 12:30 to 1:30 today, but I'd like to give Yiming, until about 1:45 inclusive of questions, just for everyone's time management. Okay, Yiming, thank you. I'm going to pass it over to you.
Thank you so much, Lena. Thank you so much to everyone for attending. It's a great pleasure to share my research with you, but in particular during work from home, it's always really a treat to be able to talk about research. And let me do full screen. So I'm also looking at COVID, but from a slightly different angle. And unfortunately, in finance, it's hard for us to give a survey to financial markets. So I'm going to be looking at prices and volumes in financial markets to understand really what some of the stresses were and what the causes of those stresses were, and what that means for the economy, for the Federal Reserve, but also for us as everyday investors. All right, and so one thing that we usually see in crisis times is a flight to liquidity, meaning that everyone gets scared of their risky assets and everyone wants to go and buy more safe kinds of assets. So think about the financial crisis. We were all scared of the banking sector. We all went in to buy, for example, the US Treasury bond, which is the US government bond, and it's considered the global safe asset. Like that's the last thing that will be safe, even if the world ends. Also, in particular, high quality corporate bonds, right, for companies that have a high rating. But this time around, what we instead saw is a reverse flight to liquidity phenomenon, whereby people didn't really want to buy into these relatively liquid and safe securities. People really wanted to sell the safe and liquid securities, right? And this includes US Treasury markets, as well as these high quality corporate bond markets in which, there was so much selling pressure that they were beginning to show signs of distress. Okay, so you may not have paid attention to this because, there was a lot of news about the stock market, and the stock market did tank for some period of time, but actually at the same time, it's really these very, very liquid and safe markets that also experienced very significant strains. Okay, so how do I know that? Well, there's prices in the market that we can look for evidence on that trend, okay? And one thing we can look at is the Treasury discount. Okay, so this is basically the difference between the interest rate swap yield and the Treasury credit default swap minus the yield on the actual Treasury. Okay, you should think that, if everything's working well, this should be zero because the credit risk in the Treasury and the interest rate risk should exactly be the same as the offsetting yield on that Treasury. But if there's issues going on in the market, then this arbitrage is going to fail, and we will see a dispersion between the Treasury yield and the corresponding price of its credit risk and interest rate risk. And that is what we indeed saw, because as March came in, there was a large decrease into the negative sphere in the US Treasury discount. Okay, and what that means is that basically the yield on Treasuries went up so much that it really couldn't be accounted for just due to credit risk and interest rate risk. And when the yield goes up, remember from the 101 corporate finance, when the yield goes up, that means prices were going down, and prices going down means that people don't want to hold that asset. They're basically selling that asset. All right, so this big gap or this big wedge in the US Treasury discount is signaling to us that there was significant and pronounced selling pressures in Treasury markets that was straining these markets. Okay, the other way we can think about this is the volatility in the market, right? So markets are very calm in normal times, but volatility goes up when many people want to trade, but then really they can't find a counterparty for that trade, or people are unsure of what's going to happen. And so the Treasury volatility was also spiking as we see these heightened selling pressures. Okay, now corporate bond markets saw similar strains. Here I'm plotting similarly the CDS bond basis, and that again is this yield of the corporate bond weighted against the credit risk price of the CDS spread of the bond. And what I'm seeing is that again, there's a large drop in the CDS bond basis, meaning there's a large surge in the corporate bond yield, meaning that lots and lots of people wanted to sell. Okay, and that is probably not super surprising because corporates suffered a large shock in the pandemic. But what's surprising is that this increase in yield or this increase in the selling pressure was not larger for the risky type of firms. It wasn't larger for high yield or junk bonds. It was in fact higher for investment grade or the higher quality kinds of corporate bonds. So all of this paints a picture that there was really these significant strains in liquid asset markets, in safe asset markets, which usually we think are the last ones to fail. Okay, so we really wanted to understand why that happened. Okay, because even if the liquid asset markets are so strained, right, then maybe we should be more concerned about something being very wrong in the underlying economy. So it's important to understand what's causing this reverse flight to liquidity phenomenon and what the implications of that cause are. Okay, and so we basically tried to look for a number of things, and after playing detective for a while, what we identified is what we think is really the prime cause of this is the increased reliance on mutual funds, and in particular mutual funds that are investing in corporate bonds in liquidity transformation. Okay, and so liquidity transformation is a role that traditionally has been served by commercial banks. And we find that if you were sticking to commercial banks in providing liquidity, we would not have seen what you've seen. And it's something very special about mutual funds and liquidity transformation that has caused this reverse flight to liquidity, that has caused the strains in these very liquid asset markets. Okay, now let me walk you through our model in just one picture. Very simple. Here I'm having a bank and a fund, and I'm plotting their balance sheets. Okay, now on the asset side, banks invest in firm loans. Okay, so those are, you can think of the firm loans as the illiquid assets. And then banks are also holding some liquid assets like cash, like treasuries, as part of their portfolio choice. And at the same time, they are issuing liabilities. So this is the liability side. And as we all know, you probably have a bank account. You're getting a deposit, right? You have a deposit account, and that is the liability of the bank. And remember, when you have a deposit, usually the bank is going to quote you a fixed deposit rate, right? They're going to say, okay, this 3-month CD, you're going to get this and this percentage if you withdraw the money in 3 months. Okay, now, if you look at the balance sheet of the fund, it is somewhat similar because on the asset side, we also have illiquid assets like corporate loans and corporate bonds, and we have some liquid assets like treasuries and cash. But the fund doesn't issue deposits, right? The fund is going to issue shares that are held by investors. Okay, so if some of you have a Fidelity or Vanguard account, and if you're investing in a fund, in a mutual fund, and invest in bonds, you will know that you have a share as a result of that claim. Okay, and they will have some advertised, expected returns, but notice that that is not exactly what you will definitely get, because those returns are just from, those are the past expected returns. What the future will hold for how much your shares are going to be worth is going to depend on expectations about the future of the economy. All right, so just to sum up, banks issue deposits. It's a debt, so it's a fixed deposit rate. Funds, they issue shares, that is an equity contract, And how much that share is going to be worth will depend on, well, everything that the fund is holding and how much that is going to be worth. All right, so when the economy deteriorates, deposit rates will stay fixed, but what happens to the fund share value is that it's going to drop. All right, another way to think about this, imagine yourself back in March and you see the markets going down. Are you first trying to check into your bank account? Or are you first trying to go and see how the fund you're investing in is doing? You probably want to go check into the fund first, because you know that, okay, if the fund's assets are depreciating, okay, then the share value that I have is probably also going to go down. Okay, and that is exactly what should be happening, because investors should think about the share value and think about whether they want to take the money out of the fund. And if they're afraid that the share value is going to decline, they should be more incentivized to take the money out of the fund. Okay, now if they want to redeem their shares or take the money out of the fund has to do something to get them the cash. And what the fund does is that the fund is going to go and sell some of its assets, and it's going to sell the most liquid assets, because those will relatively enjoy a lower discount than they're being sold, right? It's easier to sell and get rid of some treasuries into cash than it is to sell a very, very illiquid corporate loan. All right, so basically, relative to banks that issues a fixed deposit payment, investors at funds should be more concerned when the economy is going down, because their share values will go down. They will go and redeem their shares, and to meet those redemption requests, the fund is going to sell off some of its assets to pay out the investors. Okay, and it's this whole process happening that we think led to the large-scale liquidation of the very liquid assets. So investors were trying to get rid of the fund, so they're trying to fly to liquidity, but the fund is really turning the whole thing into a reverse flight to liquidity. Okay, and you may ask, well, this is a normal story about the world. How come, we only saw this time around that there was this concentrated sale of liquid assets? Well, the reason is that the mutual fund industry has increased significantly in size over the last decades. All right, so back in 1995, they were at 6.1 billion. And as of 2020, they have reached 44.4 billion. Now, the economy is also growing at the same time, but for example, as proportion of bank deposits, okay, that share has increased from about 20% to right now 30 to 35%. Okay, so the mutual fund industry is becoming increasingly important. And maybe we were not around in 1995 to already have an investment portfolio, but if you go and ask your parents, if you ask, senior members of your family or of your friend circle, how much of their wealth was invested in funds relative to banks, and if you ask yourself now how much you're investing in funds versus banks, then I'm pretty sure that on average, you will realize that we are now putting more and more of our wealth into these non-bank institutions, into mutual funds, that are similar to banks because they also invest in corporate loans and corporate bonds, but then they're issuing this claim that is an equity claim whose value is able to adjust, rather than the deposit claim of a bank with a fixed deposit rate. Okay, so the empirical evidence for the story I just told is right here. For example, we can look at how much the inflows and outflows of funds have been varying over time. And we see that, during COVID-19 in the first quarter of 2020, there's been an unprecedented outflow out of these bond mutual funds at 12%. Okay, so this big drop here is really bigger than anything else that you've seen on this graph. At the same time, these outflows were exactly as we would expect. Riskier funds had investors that were more worried, and so there was more of an outflow out of these riskier funds. So you see the yellow line is depicting outflows out of funds that are holding corporate loans. Okay, and the red line is for funds holding investment grade corporate bonds. The green line is funds holding high yield corporate bonds. So investment grade is safer than high yield. So the high yield fund investors were more worried, and they were flowing out more of the fund than investors at the investment grade fund. So, all of this seemed to align. People got scared of the underlying fundamentals of the economy. They wanted to get out of the fund in order to curb their losses. And they were especially worried if their fund was investing in these very risky asset classes. Okay. Now, what did the fund do? Remember, the fund has to give people the money and they need to sell some assets in order to have the cash to meet redemption requests. What we find is that the funds didn't really sell the risky assets. The funds were liquidating safer and more liquid types of securities in order to meet these redemption requests. Okay, so the dark blue bar over here is how much corporate bond funds were selling in terms of Treasury securities. And the dark red bar is how much they sold in terms of corporate bonds. So you see that people were running out of the fund and the fund was selling Treasury securities in order to meet these redemptions. Okay, and this really happened at a large scale, so that the fund sector in total, by the end of 2020 Q1, sold 182 billion in terms of Treasury securities. Okay, and this is comparing that sector with all other sectors in the economy, and we see that really mutual funds are right at the top here, only second to households in the rest of the world. But remember that, you know, these two other sectors have a much larger base, right? This is basically everyone else, you know, not in the US. So, you know, the significant size of the selling by mutual funds is also evident from this graph. Okay. All right. So again, large outflows and large and concentrated sales in liquid asset markets. And that is mapping back to the two graphs that I showed you at the beginning, where we saw significant strains in Treasury markets. First indicated by this widening gap between the Treasury yield and basically the arbitrage trade for the credit risk and the interest rate risk of Treasuries. And it's mirrored in the corporate bond market, where really the most high quality, the most liquid kinds of corporate bonds, the investment grade corporate bonds, suffered a widening of the CDS bond basis. Okay. Now, once again, why? And you know, why does that matter? It's because funds are issuing these shares that we hold that have a flexible value, which makes us more exposed to changes in the economy. Right? If we rather had our money in bank deposits, deposits that promise a fixed rate, then unless we think the bank is going to default, otherwise we really wouldn't worry, because no matter how the economy changes, that deposit rate wouldn't really change. Okay, and that is really the reason why, you know, we're seeing all these events from happening. And in the data that also shows up. So here we are basically finding two comparable sets of banks and funds that are holding very similar assets. And what we see is that, you know, before COVID, nothing really changes that much. But once this big negative shock hits, the outflows or the redemption requests from funds are surging significantly more than what is happening at banks. In fact, actually, there's a deposit inflow into the banking sector at the same time. Right? And over time, there's been a big migration of intermediation, of liquidity transformation from these banks to these mutual funds, which is why as the economy is experiencing fluctuations or deteriorations in fundamentals, you know, we are seeing more and more of these outflows and of these asset liquidation episodes. So the Federal Reserve didn't stand by, right? Because markets were so strained, the Federal Reserve did many things. And most relevant to what we're looking at here is the announcement of Treasury bond purchases, as well as the announcement of investment grade or corporate bond purchases. Okay, and so, you know, usually even after the financial crisis, the Fed has been doing QE, or quantitative easing, which is basically the purchase of Treasury securities and other type of mortgage-backed securities. Okay, and usually the Federal Reserve is not really there to buy risky assets like corporate bonds. Okay, so this was really an unprecedented announcement where the Fed says, okay, I'm not just going to buy safe assets, I'm also going to step in, I'm going to buy corporate bonds, investment grade, and high yields alike. So it was a very, you know, controversial policy back then. But in terms of fixing what we've been seeing, in terms of fixing these liquid asset markets and these instabilities in the mutual fund sector, actually what we find is that the corporate bond purchases were much more effective. Okay, and the rationale is that if you buy treasuries, then you're just buying what the funds are selling. Okay, and there's lots of intermediation in treasury markets that have to happen for that process to be smooth. However, if you announce and commit to buying corporate bonds in the first place, right, then you're telling the market, oh, there's nothing wrong with corporate bonds. The future fundamentals, the future outlook for corporate bonds are fine. Okay, which incentivizes investors to stay in the fund in the first place. There's no outflows, there's no sales, and everything stays as it should be without a crisis. Okay, so the announcement of future corporate bond purchases by the Federal Reserve is a more direct way of stopping these outflows or stopping the instabilities before they have even occurred. Okay, whereas the traditional way of buying treasuries is sort of cleaning up after things have happened. And in this particular episode, the announcement of corporate bond purchases turned out to be the more effective at stabilizing the fund industry, but also stabilizing liquid asset markets. All right, so that's the story, but what do we learn? Okay, first thing is to realize that what is considered safe and liquid, right? You may have some treasury funds or some treasury investments on your own, may not always be safe and liquid. Right? So that relative safety is a dynamic concept, and some of the even most liquid asset markets could become strained in times of turmoil. And the reason for that, again, is that we're really changing the landscape of the financial institutions that we have, right? We're moving more and more beyond traditional commercial banks, and we're putting money more and more into non-banks, such as mutual funds that are issuing a flexible rate equity share. Okay, and that is giving rise to a lot of the volatility in share prices, volatility in outflows by investors, and volatility in asset liquidations by the fund, and leading into the asset market volatility that we've been seeing. Okay, and for the central bank, what this means is that they need to be aware of what's happening and consider potentially purchasing more of the illiquid assets to actually stabilize the liquid asset markets, which is a deviation from its traditional role, and there's many different considerations there. But one benefit of announcing the purchase of illiquid assets is actually to stabilize the mutual fund industry and to stabilize these very liquid asset markets during downturns. Okay, and what that means for all of us, if we want to decide on what we want to invest in or where we want to put our money in, is just to realize that the bank deposit that you have and the fund share that you hold have very different characteristics in good and in bad times. Okay, if you go to the bank and the bank promises you an interest rate, that interest rate is not going to change unless the bank defaults. Okay, but if you go to a fund, to Fidelity, to Vanguard, to any other fund that is offering these bond mutual fund shares, then know that whatever expected return is being printed on paper is just an expectation, and that the reality, the realized return you will be able to get very much depends on how the economy is going to go in the future, which is hard to predict for anyone. So there's gonna be risk, there's gonna be volatility, and there's gonna be times when you want to go and take your money out, which has implications for the market, but which also has implications for you, because that means you will already have suffered a cut to your potential profitability. All right, with that, I think I'm out of time. Let me yield back to Melina.
Thank you, Yiming. That was very interesting. And I do see a few questions in the queue. I'm just going to start with a point of clarification. So when you say that safe assets suffered greater stress than other assets in Q1 2020, what measures are you tracking? Outflows, spread increases, et cetera?
Right, great question. So as in the slide, I think I'm still sharing my screen. Yeah. So one measure we've used here is basically this credit risk adjusted spread here. So we're comparing the corporate bond yields together versus their CBS implied rate. So this is basically saying after you remove the credit risk component that is obviously changing in the crisis, what is the difference between the yield and the corporate bond CDS? And sort of the wider the difference between these two, that means that there must be something that is driving people to sell or buy corporate bonds. And what we see is that, before the Fed intervened, you see that investment grade, which is the blue line here, it has a bigger gap between these two rates than their high yield counterparts. Okay, so this is a way to measure strains in the market while controlling for the actual credit risk, which is obviously different between these two sets of securities.
Good. And then another question. So did Treasuries sell more than high yield bonds, for example? not necessarily because they are risky, but because that they're everywhere in terms of liquidity. So if there is a shift, will they be affected?
That's a great question. So I think the big question is, if the total size outstanding is different, then if 1% of the total outstanding is being sold, then obviously the market that is bigger has a larger amount of net sales, right? And that is right. Treasuries outstanding is definitely bigger than the corporate bond market outstanding. But I think that one way to think about the relative strains, sort of normalizing for the volumes, is again to look at prices, right? Because if we see that prices in the market diverging more, that is a measure of the net pressure that is going to weigh the total demand against the total supply. And that total demand and total supply should both be conditioning on the size of the market.
Okay. Good. I'm just looking through here. So one more question. I'm going to read it and just let me know if you need me to repeat any part. But
yeah.
Again, going back to comparing deposits versus shares. Historically, there were run-on banks. Deposits were withdrawn when liquidity crises hit. So the question is, do you think that outflows from funds were leading or kind of equated to outflows from deposits this time? Because the deposits are FDIC insured, while funds face gates that could further strain the situation for shareholders as asset values fall.
That's a great question. Yeah, so it's absolutely right that the interest rate you're promised on the deposits, it's a promise, right? And if, as long as the bank is still solvent, that promise can be honored, and there's no change in that. But there's also a case when the bank can default, in which case there's not enough to pay that rate to everybody, which is why we have bank runs if people think, oh, the bank may default and they may not have enough money to pay everybody. Now, the probability of default in the modern banking system is largely reduced due to the incidence of deposit insurance by the FDIC, as you mentioned. So that is one big factor. But I would argue that even without that deposit insurance, still banks are issuing a fixed deposit rate. And as long as we're not in a world where we think, the bank is going to run, right? Then, the bank depositors should stay put. Whereas for equity, any just marginal dip in the fundamentals is already going to go and trigger the outcome. Okay, so we have some tests in the paper that are removing the effect of deposit insurance, and what I said was the finding to those tests. But you're absolutely right that in reality, sort of the safety of banks or bank deposits is further bolstered by the presence of deposit insurance by the FDIC. In terms of funds, I think what you mean is that the equity in reality has some frictions, or it doesn't work perfectly, so that there is some stickiness in the adjustment of the equity, and you're right that stickiness induces outflows to be even larger than in the case if we had a perfect working equity. But what we wanted to highlight is that, even if those frictions in reality are removed, if you have the perfectly flexible equity contract of shares, then we would still see these large outflows, simply because investors know that any changes in the fundamentals is going to be reflected in the value of the shares.
Okay, great. Excellent, Yiming. Thank you so much for an interesting presentation on a very different topic. I love it when we have two completely unrelated and equally interesting topics presented in the No Free Lunch seminars. So again, thank you to everyone who joined us today. I hope this was a good use of your hour over lunch, and we hope to see you again at other Program for Financial Studies webinars, which will be forthcoming. We will also be sending out our newsletter, which showcases additional research related to COVID-19 in the business community, as well as a list of our next 6 upcoming events this fall. So again, just a big thank you to both Laura and Yiming. And if there are any questions, don't hesitate to reach out to myself, Melina Dennebeim, at the Program for Financial Studies, or research related, directly reach out to either Laura or Yiming related to their respective research. Thank you.
Thank you.
Thank you.
Bye-bye.
Bye.